video. Mortgage rates. Massive leap in mortgage rates. It was over 50 basis points or something. It was up to 4.39 or 49 or something, almost 4.5%. Now hold on, I know I'm just a bozo that doesn't know anything, that currently works in a restaurant, and going back to my IT industry here in the next 30 days back in Florida. And I'm an armchair quarterback, you know, guy that thinks he knows stuff, that has studied stuff for years, and I do know stuff, and I share it with you guys because I feel like people need to know it, and you can decide for yourself whether I know what the hell I'm talking about. And the fact that my subscriber list keeps growing and growing and growing, I think that speaks for itself. So there's my little qualifications for you. But I said a matter of maybe 2 weeks ago on YouTube in a video about mortgage rates. They're going to be increasing. They have to increase. Of course, Lindsey Williams said it anyways, but historically, this is what they do. Interest rates are low. They can't stay low forever. They have to go high. And once they go high, they don't just go to a normal level of expected interest rates. They go, you know, it's like a pendulum. It swings wild this way, and when that wild is like where we're at now, where the Federal Reserve lends out to the banks at like almost 0%, and they've been able to give people with home loans and stuff 3%, 3.5% off. That big mansion that you own, or the big $200, $300, $400, $500, whatever $1,000 house you own, man, the payments are great because you got it at 3.5%. Man, the payments are fantastic. But what happens when you go to sell that house, or people are in the market currently, which is constantly, people are buying and selling, babies are born, life goes on. Every day, someone has to buy a house. So what happens when you are the schmuck that has the house with the really low interest rate, but it's time to sell the house? You're not going to stay there for 30 years. You've been making great low payments. You're happy. Time to move. Something comes up, whatever. You got to get out of the house. And you're let's call it a $300,000 house. You've been able to pay off $50,000 of it. You owe $250,000. But interest rates have now spiked to 12, 13, 15, whatever percent. And your $250,000 house is now worth about $150,000. How does that happen just because interest rates spike? Well, it happens because it's not so much the cost of a house, the actual number of what are you asking, the asking price of this house. It is, what are my monthly payments going to be? Mr. and Mrs. Bank, what is my mortgage payment monthly going to be? Oh, $250,000 house? Your payment currently at that low percent, and I'm going to make this up just for the purpose of this video because I can't do these numbers of math in my head this detailed, but 3.5% interest rate, $300,000 house, you're at, you know, let's just call it $1,500 a month. I'm just going to throw that out there. Okay, sounds good. Now you paid off $50,000. A couple years have went by. Actually, more like 4 years went by. Interest rates have now spiked. They're 12, 13%. You need to sell the house, but at least you paid off $50,000 of it, so you're down to $250,000. The person who buys that house, remember, you're paying $1,500 a month, and you have a $300,000 mortgage. Even though you paid it down $50,000, your monthly payment stays the same as you're paying it. So $1,500 a month for you. Now someone wants to buy your house. Market says it's worth $150,000. You cannot get out of the house. You're back in square one in 2008. And you had the low interest rate. So how did that happen? Because the person who's buying your house can only afford $1,500 a month. And at 12% or whatever, that house has to be at $150,000. And I'm making that number up. That's not entirely accurate if you do the math. But so in other words, the monthly payment stays the same. Therefore, the affordability has to stay the same. People's jobs are staying the same. They don't go up any month. You know, you don't get a 15% raise at your job all of a sudden to make up the difference in your mortgage. So the prices have to come down to whatever the monthly payment is. So if the interest rates spike, the housing values have to be destroyed in order to meet the equilibrium of the new payment structure due to the high interest rates. So is it any surprise to you that I just told you about a couple of weeks ago, interest rates will be rising, and as a matter of fact, Lindsey Williams said so, so take it to the bank. Not that any of us needed him to say it. This is obvious that it would not last forever. So what does that mean? If you've got cash or silver on the sideline in a good amount of it, if this timing works out right, you may have, can you imagine having 500 ounces of silver? Matter of fact, let's just look at 100 ounces of silver. And you paid for it sometime in the recent history here, whether it was a few years ago or just now or today or whatever. You got 100 ounces. And the price of silver goes to $200 an ounce. You're going to be sitting on $20,000. So, believe it or not, in the 1980s, when interest rates were like 15, 16, 17%, housing back then was between $20,000 and $30,000. How do I know this? Because my papa told me when we lived in California, San Diego. I was born in 1977, so up until I was about 4.5 years old, we were in California, and that's exactly what happened. Interest rates were very high, and he told me that's $20,000, $30,000, $25,000, $30,000, $35,000 in that range. That's what housing was going for. Again, it was all about the monthly payment. So if a house that's worth $150,000 today can be had for $40,000 or $50,000 in the near future, the only person who's going to be able to afford that is someone that has cash. Those of us, or those of you that don't have cash or silver to turn into cash, are going to have to go do what everybody does this very day. Go and get a mortgage. Got to go get a loan. And they're going to say, well, because of what the interest rates are today, you only qualify for a $40,000 house because the monthly payments will be such and such, and that's what you can afford. Whereas someone who had silver, and if you had 100 ounces of silver on a $40,000 house, and the price of silver was $200 an ounce, you would have half, $20,000, half of the payment of the house. So yeah, you could still go and finance the other side, the other half, and it would cut your monthly payments in half. However, if you had 200 ounces of silver, you could buy the house in cash. If you had 100 ounces of silver and the price was $400 an ounce, you got $40,000. There's your money to buy your house with cash, free and clear. Oh, nobody. Who cares about an interest rate? Who cares about any of that stuff? Etc. And yes, the prices of renting or rentals would also have to go up because the people who have houses nowadays who are paying that high interest rate when this spikes will have to raise their prices too because they're going to have to make their payments. A lot of people who own houses don't just own them outright when they rent them. They have a monthly payment and then they just rent it out too because they had to move, they had another house, they couldn't sell their house. At the same time, if they get foreclosed on, which is still happening to this very day, and banks have a massive amount of housing still that they have not put on the market, they still own the houses, so they'll be the ones who still have to sell the house. And because the banks own them, yes, you're going to be getting a loan with the interest rate attached, so there's no way around it. And it is just amazing that 2 weeks later, interest rates spiked to 4.50 or 4.39, whatever it was at. If you think that's the low, oh, that's all it's going to go. You got another thing coming. Interest rates are going to spike out of control. They have to. It's just the way it works. And it might be about the time old Ben Bernanke steps out of office, which is supposedly about 6 months from now, sometime in 2014. So 6 months from now, we're going to be in 2014. And coincidentally enough, that's when he decided a while ago, that's when I'm going to leave. Right. Perfect timing. Can't wait to see what happens. Anyways, gotta go. Take care.